There is a persistent myth in venture finance, repeated by accelerators, parroted by keynote speakers, and quietly relied upon by inexperienced founders, that ideas are worthless and execution is everything. The myth is comforting. It absolves institutions of responsibility. It also happens to be dangerously incomplete. Ideas, when expressed casually, are cheap. Ideas, when embedded in technical architectures, regulatory assumptions, and jurisdictional sequencing, are not. They become asymmetric assets, ones that can be extracted, mirrored, and redeployed faster by incumbents with distribution, capital, and legal insulation. That was the asymmetry I walked into. The concept itself was not revolutionary in isolation. It was a modular compliance layer designed to sit between legacy financial infrastructure and a new class of cross-border retail products, structured specifically to satisfy pre-IPO disclosure requirements in multiple regulatory regimes simultaneously. Its value was not novelty. Its value was timing, jurisdictional overlap, and the quiet fact that I had mapped the order in which regulators talk to each other. They do, more often than people admit. I presented it under NDA. I presented it with diagrams. I presented it with enough abstraction to feel safe and enough specificity to feel impressive. That was my mistake. Within 4 months, a larger firm, one I had briefed as a strategic partner, announced a product roadmap that mirrored not just the functional outline, but the sequencing logic. Same markets, same regulatory choke points, same staggered launch cadence, the same almost lyrical disregard for attribution. This is the point where most founders tell themselves a comforting lie, that coincidence is plausible, that parallel thinking is common, that litigation is expensive and distraction is fatal. All true, all irrelevant. Because what mattered wasn't the theft, it was the exposure created by their speed. They accelerated toward a multi-country launch without realizing that the legal scaffolding they had copied was incomplete because I hadn't finished building it at the time they stole it. And in that gap, in that unfinished margin, there was leverage, not moral leverage, structural leverage. They assumed the risk profile of a mature system. In reality, they had inherited the liabilities of a prototype. Under the weight of that liability, confident they were not. The IPO narrative demanded momentum. Momentum demands public commitments, and public commitments once made are discoverable. That was the opening. Most people misunderstand patents. They imagine them as locks, static protections that prevent entry. In practice, patents are terrain. They shape movement. They define choke points. And, when used offensively, they slow enemies down long enough for gravity to do the rest. I had filed provisionally, not broadly, broad patents invite challenge, but narrowly, with claims designed to overlap only at the exact interfaces required for regulatory interoperability. On paper, the filings looked modest, almost timid. That was deliberate. The loophole was geographic. Patent enforcement is often discussed as a binary, enforce or don't. In reality, enforcement is staggered, selective, and deeply political. Certain jurisdictions, Germany, South Korea, Australia, and Singapore in this case, allow for rapid injunctive relief when a product plausibly infringes on a technical claim tied to compliance infrastructure. You don't need to win the case, you need to pause the launch. Their legal team assumed, reasonably, that any challenge would originate in the United States. They prepared for discovery battles, drawn-out proceedings, manageable PR exposure. They did not prepare for 4 parallel injunction threats, each with different timelines, judges, and procedural thresholds. The filings were not dramatic. No press releases, no public accusations, just quiet motions, filed days apart, triggered by their own pre-launch disclosures. Disclosures they could not retract without alarming investors. The effect was immediate. Product teams froze deployments. Compliance officers escalated internally. Regional partners demanded clarity. And, most importantly, the IPO narrative fractured. Momentum became hesitation. Here is the unglamorous truth. Markets punish uncertainty more aggressively than wrongdoing. Theft can be explained away. Delays cannot. What followed was predictable. Settlement inquiries framed as collaboration. Requests for cross-licensing that acknowledged, without admitting, dependency. All of it wrapped in the polite language of strategic alignment. I declined most of it, not out of spite, out of arithmetic. Every week their launch stalled increased my relative bargaining power, not because my product advanced faster, but because theirs decayed in public confidence. Analysts adjusted timelines, underwriters revised projections, risk premiums crept upward like an invisible tax. This is where founders often overplay their hand. They demand apologies, they demand equity, they demand validation. That instinct is understandable and fatal. I demanded silence, territorial withdrawal, and a licensing structure that converted their scale into my revenue. No joint press, no public narrative correction, just contracts. Some would call that mercenary. I would call it accurate. Because in markets where ideas move faster than ethics, restraint is not virtue, it's mispricing. And anyone who still believes otherwise has not watched the product launch die slowly, bureaucratically, and in full view of its investors. The mistake most executives make when confronted with legal resistance is assuming the threat is existential. It rarely is. Injunctions don't destroy companies. Lawsuits don't erase products. What they do, quietly, methodically, is deform time. And time in late-stage corporate finance is a brittle variable. The first injunction request did not land like a bomb. It landed like an accounting adjustment, a regional delay, a temporary procedural clarification. The sort of thing executives reassure boards about in clipped, rehearsed sentences. But the second filing reframed the narrative. The third confirmed a pattern. By the fourth, the pattern had become signal. Internally, the company was forced to do something it had aggressively avoided: reconcile its public optimism with private uncertainty. Launch calendars were rewritten. Contingency decks proliferated. Senior leadership began asking compliance teams questions that should have been asked 6 months earlier. And compliance teams, when pressed under time pressure, tend to speak plainly. The core problem was not infringement risk per se, it was architectural dependency. Their product, built for speed, not scrutiny, could not be easily decoupled from the interfaces covered by my claims without triggering a cascade of secondary approvals. Re-engineering was possible, recertification was not. This is the detail investors never see but always feel. Every delayed launch window forced underwriters to revise forward guidance. Every revision widened valuation bands. Every widened band increased perceived risk. The roadshow narrative, once linear and confident, became conditional. If approvals proceed, if timelines hold, if jurisdictions align. Markets disliked if. What followed was a subtle but devastating shift in posture. The company stopped announcing dates and started issuing updates. It stopped projecting inevitability and began emphasizing resilience. That rhetorical pivot, small as it seems, is often where momentum quietly dies. I monitored none of this emotionally. Emotion distorts timing. Instead, I tracked secondary indicators: analyst note language, supplier contract amendments, job listing freezes in regional operations. These are the tells of institutional hesitation. They appear long before public acknowledgement. At no point did I escalate publicly. Silence was more destabilizing than accusation. It forced them to speculate internally about my next move, about which jurisdiction, which filing, which interface might be targeted next. Legal teams prepared for scenarios that never materialized, consuming resources and attention in the process. This asymmetry, where my costs remained static while theirs compounded, was the real leverage. Litigation is often framed as expensive. In truth, defensive litigation is expensive. Offensive positioning, when pre-planned, is remarkably efficient. By the time their executive committee formally discussed settlement parameters, the damage was already embedded in their timeline. The IPO window had narrowed. Competitors sensed vulnerability. Regulators, alerted indirectly by procedural filings, began asking questions unrelated to my claims, a predictable if inelegant bureaucratic reflex. At this stage, the outcome was no longer uncertain. It was merely pending. And here, a professional judgment is unavoidable. Any leadership team that allows an IPO-critical product to hinge on unverified third-party intellectual property assumptions has failed at a strategic level. No amount of capital can compensate for that oversight. There is another myth that circulates freely in boardrooms: that scale itself is a defensive weapon. That being large, well-funded, and globally distributed somehow inoculates a company against precision risk. In practice, scale often amplifies exposure. The larger the organization, the more rigid its dependencies. The more jurisdictions involved, the more procedural seams exist. And seams, once identified, can be stressed. They assumed my position was weak because I lacked distribution. That assumption guided their behavior from the beginning: dismissive licensing terms, delayed responses, strategic silence masquerading as confidence. They confused asymmetry of size with asymmetry of control. Control resides where decisions cannot be easily reversed. Once they committed publicly to a multi-country launch strategy, retreat became costly. Once they aligned marketing, sales, and compliance calendars, deviation created internal friction. And once they briefed institutional investors on growth narratives anchored to specific geographies, flexibility evaporated. This is the paradox of scale. The very systems that enable rapid expansion also constrain maneuverability. My filings exploited that constraint, not aggressively, surgically. Each jurisdiction was selected not for market size, but for procedural velocity. The objective was never to block revenue outright. It was to force executive attention away from growth and toward defense. And attention in complex organizations is finite. As weeks passed, leadership became reactive. Decisions that once took hours took days. Days became weeks. Underwriters requested clarifications. Clarifications triggered internal audits. Audits uncovered documentation gaps that had nothing to do with me, but everything to do with speed. This is where the narrative subtly inverted. I was no longer the obstructive party. I became the variable that exposed fragility. Eventually, they reached out, not with demands, but with proposals. Licensing structures, market carve-outs, revenue share models framed as partnerships. The language shifted from entitlement to accommodation. That shift is always diagnostic. I accepted selectively. Not because compromise was attractive, but because resolution at the right moment preserves leverage elsewhere. 4 countries froze their launch. 2 were licensed under terms that converted their scale into predictable cash flow. 1 market they exited entirely. There was no victory lap, no public reckoning. The press never noticed. Investors moved on, absorbing delays as execution risk. But the internal lesson, if they were honest, was unavoidable. Scale did not save them. Speed betrayed them. And in copying what they did not fully understand, they surrendered control over their own timeline. That is not misfortune. That is strategy failing under scrutiny. There is a moment in every complex corporate conflict when legal exposure stops being a legal problem and becomes something else entirely. a force that distorts decision-making across unrelated domains. That moment is subtle. It does not arrive with court rulings or headlines. It arrives in spreadsheets. By the time the injunctions were no longer hypothetical, the finance team had already internalized the risk. Forecast models began to show stress, not because revenue was gone, but because certainty was. Probabilistic outcomes replaced linear projections. Sensitivity analyses multiplied. The numbers still worked, barely, but only under assumptions no one was willing to defend aloud. This is what I mean by financial gravity. Legal uncertainty exerts downward pressure on valuation long before it resolves. Not through loss, but through hesitation. Capital becomes more expensive. Optionality narrows. Strategic patience evaporates. And all of this occurs while the product technically still exists. Their CFO understood this immediately. You can tell when a finance executive grasps the problem not as a fight, but as drag. The questions shifted from "can we win" to "how long can we carry this?" a far more dangerous inquiry. IPO preparation is intolerant of drag. Roadshow narratives rely on rhythm. Analysts expect cadence. Any disruption forces recontextualization, and recontextualization invites scrutiny. Suddenly, questions that would have been waved through 6 months earlier demanded footnotes, appendices, and legal caveats. Every caveat shaved basis points off enthusiasm. Meanwhile, my position remained unchanged. No public escalation, no additional filings, just a quiet presence of unresolved risk sitting beneath their growth story like a fault line, unmoving, patient. This asymmetry unsettled them. They attempted to reframe the situation internally as manageable, a contained issue, a timing mismatch. But timing mismatches are precisely what markets punish most severely. Delay without explanation is tolerable. Delay with explanation is not. And the explanation, however sanitized, pointed back to intellectual property exposure. This is where the myth of "just settle" collapses. Settlement is not a reset. It is an admission. In post-mortems, companies like to blame complexity, regulatory complexity, market complexity, organizational complexity. These explanations are comforting because they imply inevitability. What they avoid confronting is the far simpler truth. Speed, when mispriced, becomes liability. They believed velocity insulated them, that by moving quickly, launching broadly, disclosing confidently, committing publicly, they could outrun any structural weakness inherited along the way. This belief is common among well-capitalized firms, and that is almost always wrong. Speed magnifies assumptions. Every accelerated decision embeds trust. Trust that dependencies are sound, that counterparties are clean, that intellectual property boundaries are well understood. When that trust is misplaced, speed does not conceal the flaw, it broadcasts it. Their execution was, by most operational standards, impressive. Teams delivered, deadlines were met, markets responded. But none of that compensated for the fact that the underlying legal logic had been borrowed without comprehension. They executed perfectly on a foundation they did not own. And ownership in this context is not philosophical, it is procedural. The filings forced them to confront an uncomfortable asymmetry. They had optimized for launch velocity, while I had optimized for interruption. Their systems were built to scale forward. Mine were built to stop sideways motion. When those systems collided, forward momentum did not win. This is not a moral observation, it is mechanical. Internally, I imagine the lesson was reframed politely. A reminder to strengthen diligence processes, an emphasis on early IP audits, perhaps a new line item in risk committees. Institutions are very good at absorbing failure without naming it. But failure it was, not because the product stalled, not because revenue was lost, but because control over time, a scarce and unforgiving resource in public markets, was ceded to an external actor with fewer constraints. That should never happen. What made it worse strategically was that the exposure emerged not during experimentation, but during transition, precisely when narrative cohesion matters most. Pre-IPO companies live in a narrow corridor between promise and proof. Any disruption in that corridor feels larger than it is and costs more than it should. They learned that lesson publicly if they discussed it privately, and once learned, it cannot be unlearned. In post-mortems, companies like to blame complexity, regulatory complexity, market complexity, organizational complexity. These explanations are comforting because they imply inevitability. What they avoid confronting is the far simpler truth. Speed, when mispriced, becomes liability. They believed velocity insulated them, that by moving quickly, launching broadly, disclosing confidently, committing publicly, they could outrun any structural weakness inherited along the way. This belief is common among well-capitalized firms, and that is almost always wrong. Speed magnifies assumptions. Every accelerated decision embeds trust. Trust that dependencies are sound, that counterparties are clean, that intellectual property boundaries are well understood. When that trust is misplaced, speed does not conceal the flaw, it broadcasts it. Their execution was, by most operational standards, impressive. Teams delivered, deadlines were met, markets responded. But none of that compensated for the fact that the underlying legal logic had been borrowed without comprehension. They executed perfectly on a foundation they did not own. And ownership in this context is not philosophical, it is procedural. The filings forced them to confront an uncomfortable asymmetry. They had optimized for launch velocity, while I had optimized for interruption. Their systems were built to scale forward. Mine were built to stop sideways motion. When those systems collided, forward momentum did not win. This is not a moral observation, it is mechanical. Internally, I imagine the lesson was reframed politely. A reminder to strengthen diligence processes, an emphasis on early IP audits, perhaps a new line item in risk committees. Institutions are very good at absorbing failure without naming it. But failure it was, not because the product stalled, not because revenue was lost, but because control over time, a scarce and unforgiving resource in public markets, was ceded to an external actor with fewer constraints. That should never happen. What made it worse strategically was that the exposure emerged not during experimentation, but during transition, precisely when narrative cohesion matters most. Pre-IPO companies live in a narrow corridor between promise and proof. Any disruption in that corridor feels larger than it is and costs more than it should. They learned that lesson publicly if they discussed it privately, and once learned, it cannot be unlearned. There is a tendency, especially among founders and operators, to view conflicts like this as anomalies. Edge cases where unusual preparation meets unusual opportunity. That framing is convenient, but inaccurate. This was not an exception, it was a demonstration. In modern corporate environments, enduring leverage does not come from secrecy, aggression, or even originality. It comes from understanding where systems overlap imperfectly and positioning oneself precisely in those overlaps. Legal frameworks, regulatory timelines, disclosure obligations. Each intersection creates friction. Friction, correctly anticipated, creates leverage. I did not win because I was more inventive. I won because I was patient in places where they were hurried, and specific in places where they were broad. My filings were narrow, my actions were restrained, my objectives were modest but precise. That combination is uncomfortable for large organizations. They are built to respond to threats that scale visibly. They struggle with pressure that remains localized, procedural, and unresolved. And unresolved pressure is corrosive. What persists after everything else fades is not the patent, or the licensing revenue, or even the strategic advantage gained in that moment. What persists is the altered behavior. Their future launches will be slower, their disclosures more cautious, their internal reviews more defensive. In short, they will pay a tax, forever, on velocity. That is the real outcome. As for me, the lesson was equally clear. Power that must be asserted loudly is rarely stable. Power that operates quietly within rules everyone else assumes are background noise tends to last. It shapes incentives without announcing itself. No one involved will tell this story publicly. There is no upside in revisiting it. The market prefers clean narratives, and so do institutions. But the effects are still there, embedded in timelines, contracts, and cautious executive instincts. And if there is a final judgment to be made, one that steps briefly outside pure analysis, it is this: companies that mistake speed for safety deserve neither when scrutiny arrives.